All right, team, what's going on? Welcome aboard to our 2024 market predictions, kind of what I'm seeing for the market in the future for this year. 2023, we had a pretty good year in terms of predicting what was the outcome. For example, we did call the top in July, we had the flush in October, and then we had the rally towards the end of the year. That was part of seasonality. We did not get quite to all-time highs by the end of the year. In December 31st, 2023, we got all-time highs just this past Friday. That was the 19th. So 19 days a little too early. But either way, we had lowering rates, lower dollar, lower inflation, just as we expected. So all of those markers hit. If you want a little more detail on how our perception of the market was in 2023, check out the video Top 10 Stocks of 2023 Revisited, and also the top 10 stocks of 2024. We also talk about what we're seeing for the future in terms of stocks. All right, here we are, S&P 500, right? Start with the beginning. All right, so first thing I want to talk about here is some technical levels. And again, I went over this just this past video in regards to the weekly recap about being overbought, for example, on AMD. This is a weekly chart. We're above every major moving average, break out all-time highs, you know the drill. But we also have a little bit of oversold points. Last time we were this oversold, guys, was in July. And if you guys remember the video we did then, it was clipped that, hey, we get a little bit of a breather, and everyone was really bullish then. So what I'm expecting is us to get a pullback to two markers. 4630 S&P 500 spot. That'll be a retest of the breakout. We can use that as support, and if we bounce, that's completely healthy. So all we're looking for is a retest. And then the second one is the retest of this trend line that we've had. That is right near the 20-day. So 45.05, that's kind of the drawdown that we're expecting in terms of max drawdown. Worst case scenario, all things being bad, we'll get back down to 43.55. So if you have levels to buy in terms of stocks or levels where you're starting to see, oh, I'm getting kind of interested, I think you can nibble at 46.44. You can start really getting that plate ready for 45.10 and 43.47. That's where you're hitting the buffet, let's just say. I find it highly unlikely with the environment that we have now, which we're going to go over here, the macro now, 41.87 being the 100-week moving average. Again, this is the 20-week moving average. So again, this is stretched out in the past 3 years. So we have a little bit of some context there. But again, pure breakout, nothing more we could say. In terms of how high can we go? Well, here's the prediction for 2024 SPX. 52.44 is the number. 52.44. So that's around above 10% from the closing price of December 31st, 2023. And I'm going to go over now the macro environment first, kind of talk about what I'm seeing that would support that kind of move. And again, we're at 48.39 now. Again, all-time highs were just hit. So kind of easy to, hey, we're going to go higher, that kind of prediction. But I fully expect us to get a correction this year. I fully expect us to retest some levels. Again, like you said, 46.35 and right around 45.44 or so. We'll just call it 4,500. How's that? That's kind of the levels I'm expecting us to get to. Again, we're starting to get overbought. Not the first time. We have earnings coming up now. So now we have to justify these stock moves with the earnings that are coming out. So again, it's going to be step by step, day by day. And all we can do right now is wait for those earnings coming up, and earnings season is about to kick off. Netflix being one of the larger tech companies out there that everyone watches, and Tesla this week. So those two are going to be important. If you want a little more detail on those names, make sure to take a look at our weekly recap that we posted today. Okay, let's get to the macro. We'll start with 10-year Treasury yields. Why is this important? Again, lower rates, lower inflation, lower dollar. So I'm going to adjust that in 2024. I do expect a lower dollar. I think inflation continues to go down, but not as fast as we did in 2023, obviously. And yields, I do fully expect us to get eventually to 31.43, which is around 3.1%. Now, we're starting to get a bounce now. Again, I think yields are kind of hinting to us of the possible overbought pullback that I'm expecting on stocks. So again, we're starting to get a little bit of a peak higher. Again, if we start getting to the 4.4 range, 4.3, that's where things start getting interesting. We have the 100-day moving average here at 4.378. We're above the 200-day. We're above the 20. We are not quite yet at a death cross on 10-year Treasury yields. If that death cross does happen, this is definitely going to be beneficial for stock investors because now we're going to have lower interest rates. So again, your high betas, your heavy growth, they're going to be the beneficiaries, tech as well. So 10-year treasury yields getting close to a death cross. We're not there yet. We need this yellow line, the 50-day, to cross below the 200-day. But as we are bouncing, let's see if that 50-day does hold as resistance. What I'm expecting is that if we do get some kind of correction or pullback in stocks, like I'm expecting those retests to happen, we're probably going to get to around 4.3 to 4.5% on a 10-year treasury yield. And again, that just gets us back to levels not seen since 2022 October. Okay. So again, all we're looking for is just to hit back that resistance and pull back down and see if we get that death cross. And eventually we're looking at 3.143%. Now, what's the big caveat here? The big caveat here. Let's go ahead and expand. The big caveat here, obviously, is the Fed, guys. And the Federal Reserve is extremely important when it comes to 10-year treasury yields, because if the Fed lowers rates, then we know that we're going to get a little bit of QE, let's say QE environment, not exactly QE. But remember, if rates are coming down, that's going to affect 10-year treasury yields. Very, very important, the Fed funds rate. Now, again, all this can change with bond auctions, of course. But of course, if the Fed is cutting rates, the market is going to price that in, and down we go. So 10-year treasury yields are going to be in focus for the next Fed meetings. The expectation is a cut in March, about a 50% chance. I don't believe that's going to happen. I think more than likely the case we're going to get the cut in the summer. I don't think we get that earlier than that. So summertime, I would say around the June meeting or May, that's when we'll get the cut that people are expecting. I just don't think it's ready for it now. Okay, let's go to the dollar. In regards to the dollar, we have a death cross, which is the 50-day below the 200. So I fully expect the US dollar to pull back to below 100. That just knocks on the door near a triple bottom. And again, we keep knocking on the door, same in December. We're going to come back down on the dollar, and we're going to continue to come back down until we get to around 98.95. If we can break that below, more than likely that'll get us to where we want to go in terms of 5,200 S&P by the end of the year, a 10% move. Really what we're looking for is a retest of January 2022 levels of the dollar, which is right here at 97.55, gets you back down to this downward trend line and below it. So we're just looking for that sub 100 break. Once that happens, then we fully expect stocks to continue to go higher. Back to SPX here. Okay, so that's kind of the macro. Again, the dollar and yields, very, very important. What does that mean for the S&P? Again, lower dollar means the stocks are going to go higher because they're pricing the dollars. And that's also going to help cryptocurrency. So very, very important to keep an eye on that. So let's start taking a look at some seasonality. And here's what we're expecting in terms of the stock market this year. As you know, 2024 is an election year. So here you have 4 different types of data. The black line being all election years combined. This is kind of the average in terms of seasonality. A sitting president running, as you know, President Biden is running for re-election. And then you have an open field. That's very similar to 2016, where Barack Obama was not running for re-election. And it wasn't the same as 2020 because President Trump was running for re-election, right? So what we have now, again, is sitting president running. So we can go by that kind of seasonal pattern. So we're right here in January. We are up to all-time highs. Do we get that strength into February and continue higher till mid-February? And then we pull back towards the tail end. And then March, we have more pain. More than likely, I kind of agree with this here. Why? Because this is right around the Federal Reserve rate expectation meeting. And if we do not get a cut as people are expecting or traders are expecting, we're probably going to pull back a little bit. Bounce back up into March, kind of choppy in the first quarter, as you can see. And then we start moving higher in April. Into May, we pull back a little bit. But as you can see, the real jump happens in the summer, right as we start getting closer to the election cycle. Right around here, we don't know what's happening. Again, all the polls, all that stuff is happening. We start getting data. I think it's safe to say that inflation readings are not as heavy to the market as it used to be, like in 2022 and in 2023. We know that inflation is falling. Yes, we'll show you guys a couple of charts here in a second. But I think what the market's pricing in or trying to price now is who's going to win the election. That's really it. Kind of what's the forward guidance on the economy? Does the jobs market still hold? What will it be if President Trump wins another election? What would happen if President Biden wins re-election? A lot of factors at stake. I mean, everyone gets a chance to vote, obviously. So again, we have to just wait and see. We have all the way till November. You have debates. You still have primaries running. Polls can change quickly. Obviously, if the economy is doing better, that's going to shift polls. We saw that in regards to the University of Michigan sentiment statement. Like I said, gas prices and stock market are real big barometers for people. So again, right in the summer, right when the election season starts cooking, that's when the market starts cooking higher. So all I'm expecting here is that in the first half of 2024, we're going to get a retest of some kind. Again, either at 46.38, which would be support, and then we bounce higher, or right around 45.30 and we bounce higher anyways. Worst case scenario is we just chop around until the election itself. I don't think that's the case. Again, I just fully expect the first half of the year, really earnings to do everything. Really, earnings is going to set the tone. And I think the expectations are just too darn high for everybody at the end of the day. We're really just pricing in perfection at this point. Lower and lower rates, lower and lower dollar, more and more sales. Everyone is working. Political situation, geopolitical situations tends to be okay, at least relative to what people are expecting. It just seems that it's kind of the Goldilocks scenario. I remember seeing this in July, and then we had the October pullback. And once we got the October pullback, everyone thought the world was going to end. That was oversold, and we bounced to all-time highs. So again, human beings are very fickle. We see what we see. It's not easy to do predictions and get them right, but you have to look at the markers out there. You have to see what's really changing in the market. What has changed from October to now, other than lower dollar and lower rates? These companies still need to report their earnings. We still need to see their guidance. We are trading at very expensive multiples. We're not asking for go to zero. We're not asking for pain. We're not asking for the world to end. All we're saying is a breather, so we can go ahead and actually get a crack at buying the dip. That's really it. We just want a deal. Black Friday shopping. What most people want. Would I be a buyer here of any stock? Absolutely not, unless you're dollar cost averaging. Right here, no stock at these levels here where the S&P is at forward guidance where it's at, and PE multiples being expensive. I don't see any reason to want to jump into anything in terms of stocks at this very moment. And that's just the S&P. Let's take a look at Qs. I mean, Qs are on fire. They're on overbought territory again, just like SPY, just like S&P futures, just like SPX. We're at a 72 QQQ RSI. Last time we were there was back in December 20th, and we had Grinchmas, and I remember that very, very well. How about SPY? Not an overbought yet, maybe have a little more. Last time we were there was Grinchmas as well, right in the mid-time of December, or towards the tail end. July, if you remember this pullback here at 459.49, got back down to 434. No one was expecting that, got the bounce. And again, guys, stocks are not linear. So wish it was that simple. Just go up forever. Doesn't work that way. And again, all I expect is the first half of the year to have some volatility, give people a chance to get a breather, and maybe a chance for people to buy the dip. That's really all I'm expecting in that end. I don't expect earnings to be as strong as people expect. I think we're going to get somewhat of a disappointment in that. I don't know if labor can stay this strong that long. Maybe around midsummer is where we actually get that cut as the labor market starts to crack a little bit. We're starting to see some layoffs pile up, as you know, in some of the big companies like Amazon, for example. Sports Illustrated, I know magazines, no one reads them anymore. They just laid off their whole unit. The whole company's gone. So again, take it with a grain of salt. We know that this job market is very, very strong, as we've seen with unemployment claims, but it doesn't last forever. And that goes both ways with stocks, and it goes with the job market. I expect a little bit of a pullback in jobs, of course. Does this Federal Reserve actually cut rates fast enough to catch any kind of pullback in the labor market or any kind of crack in the labor market? And that's kind of what people are expecting, that the Fed is just going to be quick to answer. Remember, they are looking at lag data, so are consumers. Now, finally, according to the Wall Street Journal, people are starting to feel more confident in terms of economics and the market, or really the economy. But with that being said, let's go ahead and pivot to see what's happened historically. So let's look at it. This is from Ryan Dietrich. Down more than 10% like in 2022, and then up more than 10% like 2023. What happens next? Safe to say, don't expect another 25% year. I agree. But higher all 6 times, about 11.7% on average, is another clue. 2024 should be green for stocks. I agree. Again, just going back, median 10%. And that's kind of where I'm basing my number. Again, nothing super hot like 2021 or 2020 or 2023, 2022 being the red outlier of those years. 2020 was weak, obviously, during COVID, but then it got stronger towards the tail end. I expect us to kind of just have one of those years where, 10%, 9% or so. Again, we're a little stretched. So the bull narrative is there for more upside. But again, how much more can we go? And the seasonality here. I just showed you guys. We're going to watch this very, very closely. Again, I expect choppiness into the first half. Urban Carmel agrees as well. Chopping flat through April. There's the monthly performance during election years. January is relatively flat. We have about 10 more days left of the month. February doesn't look as great. March tends to do okay. April is going to probably be flat. And then this is seasonally during election years, S&P. May pulls back, and then the summer rally we get. And then we pull back as we get closer to the election cycle, election days in November. September, October will be weaker. We'll have debates. Things will get really, really nasty. Obviously, November, you can see we push higher, and so is December once the election is done. What else we got here? I know I had one more piece of information for you guys. Okay, so we have our seasonality. I'm going to go and minimize that. All right, let's go and look at an interesting take. And if you guys remember in 2022, if you guys were watching the notes, I talked about how this is very similar to the 1980s. We had an older gentleman in the White House in the 1980s. He was elected, Ronald Reagan. And he also had high mortgage rates, high inflation rates, high Fed funds rates, with Paul Volcker being the Fed chairman. At that time in 1980, he got elected and he beat a sitting president. Sound familiar, obviously. President Biden being President Trump in 2020. It started off great. He passed off, this is Reagan, passing some tax cuts, deregulation, and then we had a double dip recession in 1982. So he was hit politically on that. They were about to kind of revoke the Reagan tax cuts, or Reaganomics as they were calling them. Now we have Bidenomics, right? And inflation was still high with a double dip recession in 82. And then what happened? Things started to get better. And what happens then? Well, sitting presidents, when economies are doing pretty good, the expectation is that they win. Now, again, anything could happen, as we know. But here's the Consumer Price Index. This is CPI, starting since 1980 to 1990. Now, again, I'm going to talk about secular bull markets now. So let's take a look at this piece of data. Okay, as you can see, in 1980, Ronald Reagan gets elected. We were in a recession. 1982, sound very familiar to 2022, where we had the inflation pull back into 2023. So you get kind of 1 year lag, I guess. 1983 is when things start to work out. 1984 is when things start to get really better. Ronald Reagan wins in a landslide. Inflation continues to creep down through his administration, really towards George Bush first administration, where inflation kicked up in the post-Gulf War in 1991. So there you go. This is the CPI. So let's go ahead and go over CPI in the past 10 years. Ignore this. This is the data points here. This is 2014. We're in 2024. And again, we had our election in 2016. We went a little higher in inflation, started to pull back in 2018. If you guys remember that pullback that we had when the Fed increased interest rates, 2019, very smooth sailing. And then we had massive deflation during the COVID recession in 2020. But we hit the bottom there, and then we bounced right into 2021. Inflation keeps going higher. Inflation peaks in 2022 July, as we said back in the last video that we had last year, previewing the year, with the numbers falling, the law of averages, that July CPI number being the peak. As long as we go against that, we're going to be fine, because it's going to be a lower number. And then this is when oil prices and gas prices peaked. And then we continue to go lower, very similar to the Ronald Reagan 1980s CPI pullback. So again, this is kind of the only an analog that I can go by, at least politically, in an election year. So with that being said, we also have one more piece here. This is the macro trends chart. This is a historical chart since 1950 or so. Let me see if I can get this. 1929. There you go. Since the crash, the great crash. And all the way up we go, right? Through great recessions, through great depressions, Vietnam, World War II, you name it. So let's go and take a look by president where we are. Joe Biden, Donald Trump, Barack Obama. As you can see, based on where we are, Barack Obama had a higher return in terms of the stock market. Mind you, he was elected in 2008 during the throes of the Great Recession. Donald Trump won in 2016, had a 41.5 return. Obama 58.9. Biden's at 30.3. We're at all-time highs now. So we'll see how much we continue. But Trump got that pulled back in 2020, as you know, but then we continued to go higher. Obama has the higher return, as we're still waiting to see what the Biden return will be. And really, if you look at this, really forget politics here. Just look at the three lines. They're pretty congruent. They work very well together, look pretty close. So I'm just going to say something that maybe some people may not like, and that's fair. It's that it's really based, guys, on timing. Some presidents have good luck, some don't. And yes, policies do matter. But for the most part, let's be completely honest. Stocks always go up over time, regardless who's in the White House. You can have Elmo in the White House if you wanted. It's just the reality. Again, the market is just responding to what their future perception is, whether good or bad. And that's it. But eventually, even through Obama, it didn't matter the party. It just keeps going higher. So if we lengthen the term of Biden, do we expect, if he wins, to come back down? Or do we expect the same trajectory of Donald Trump? Granted, during the tail end of Trump's administration, we had COVID recession, we had stimulus, all that good stuff. Are we expecting that through the end of 2024? No, but we expect rates to be lowered. So again, that should help the cause in terms of the stock market. Yes, I'm being a little jaded saying that, oh, well, in election year, of course, there's going to be some kind of rate cuts to help the president win or what have you. Guys, yes, the Fed and politics are separate, but this is reality. That could be the case, but let's not be jaded. We see what we see. I don't see this economy right now is needed for any kind of rate cuts. But if inflation does keep going down and we start seeing hints of deflation, yeah, you're going to get rate cuts. So again, kind of want to reiterate the point in terms of that choppy first half. Then we're going to, at least the highs where I expect is 5,200 by the end of the year. But with that being said, until the election season really heats up in the summer where we have the primary set, start having the conventions, and then you start having the debate set up, that's really all we can do is wait. Presidential elections aside, I still expect that retest. I don't care who wins. And afterwards, the market's going to go up regardless of who wins, because that's just the reality of things. It's more economics than it is presidential. Yes, initially, you will see some kind of volatility one way or another. That's just what it is. What I see here is that the closer it looks throughout polls that Donald Trump is going to win, rates seem to go higher. The dollar seems to go higher since he has more protectionist, populist kind of economic stances. The China tariffs, the EU, NATO, again, very, very not isolationist, but more populist, let's just say. And President Biden's more, a little more towards the world coming together, UN sort of thing. United Nations is what I mean, working with NATO and allies. And again, as he wins, and again, there's one thing the market doesn't like is change. So again, if the markets are going higher and we start seeing polls shift one way or another, that might be just a coincidence, really. Kind of focus on what's in front of you. Don't worry about who's going to win and who's not. We have no control over that. All we can do is see the reaction. So an election year, yes, it's different. You also have governor races. You also have the House for Congress. You also have Senate races. So it's just more than just the president. It's important to vote even for your local county commissioner or your local sheriff or your local judge. What matters is to vote. Democracy is important to everything here. This is why we have capitalism working, because we have democracy. That's what matters. So, let's not put so much emphasis on who's winning the polls and who's not and what's happening and what's not. Debates this and things are going to come up either way. Just trade what's in front of you. And really what I see is just that pullback's going to come, that retest. And that's really it. probably all the fireworks we'll get for the end of the year. I still expect inflation to come down. I still expect, inflation to really chop and come down a little more. But the dollar and yields, I do expect that to come down, which will help stocks. But all we're looking for here to kind of put it all together is really just a retest. Again, our levels 4638, right around 4500 S&P. Those are our really major two levels where we're looking to buy. So we will see what we get in the future. So much to happen. It is January 21st, 2024. We'll check into these predictions as we go along through the year. With that being said, let's make it an amazing year, regardless of what happens. Have a great rest of your year. And we'll see you for the next recap in 2025. How's that? See you guys then. Cheers all.